Good afternoon and welcome to today's Market Minute. I'm Matt Krajna, Co-Chief Investment Officer at Nottingham Advisors. For today's topic, I want to recap yesterday's CPI report for August inflation readings. Came in a little bit hotter than expected, even though headline expectations did come down from July and from June. The core CPI number, which is core meaning ex food and energy, did rise 0.6% month over month, double what market expectations were for an annualized rate of 6.3% for the year over year metric. And so really what that shows is despite a fall in gasoline prices, we probably all heard it by now, prices at the pump are down for 92 straight days. Energy prices have come down, commodity prices have come down. We all expected that inflation would come down with it. And while that was true for parts of the inflation report, the other side of the ledger did show meaningful increases in areas such as healthcare, shelter, and utility bills. So taken together, the market didn't like yesterday's report. The S&P was down about 4% on the news, and NASDAQ down almost 5%. Interest rates rose pretty significantly on the news as well, based on expectations for increases in the Fed funds rate from the Federal Reserve over the course of the next 3 to 4 months. And really now where we stand is at a critical juncture where the Fed's expected to go 75 basis points next week. The probability of a 100 basis point increase actually jumped yesterday to 30%. And while we don't think that's the base case, we do expect that more jumbo rate increases by the end of the year are likely, meaning that for the course of 2022, the Fed may raise interest rates by more than 400 basis points. And while monetary policy acts with a lag, it takes a little bit of time to bleed into the economy. Don't really know how that's going to affect household budgets and balance sheets, underlying businesses and fundamentals. And so taken together, it's probably going to be something that needs watching very closely, might break something under the surface, but only time will tell. And really the risks now are whether the Fed has tightened too far, too fast, and whether or not the underlying economy can handle it. So please stay tuned for future updates, and we'll keep you posted on future readings of CPI.